It's Bruce here, Uncle Bruce here, Stock Markets with Bruce. Welcome to the show here. Stock Markets in plain English. Today is Wednesday, August the 18th. Cheers, everybody. Got my caffeine-free Coke going here at 5:30 in the morning local time. We're putting in the hours. It's nice to see it. Let's see how the markets do today. Maybe they'll do a little better than yesterday. Would be kind of nice. I think we deserve a little better than yesterday, wouldn't you say? I have that IBM call contract that I bought for January. Expires 145 for 985 premium. Are you saying I could write a contract? Is there a risk? You have a January contract with a 145 expiry. You might be able to write contracts higher than that against it. Yeah, you might be able to do that. Again, those of you who are asking these questions, you're probably trading on a platform. You know, you're obviously using a platform to do these transactions. So, what you may want to try and do is let's say experiment and say, okay, well, let's pretend I'm going to write a call option on IBM for say $146 a share, expiring 2 weeks from now. It doesn't even matter what it is, but let's say it's that one. Try to enter the order, like put an order entry together without hitting the execute button, and see if your platform will tell you what kind of margin you need, whether it's an eligible trade or not, because some of you may not have enough level eligibility to do these trades. Again, every broker is different. There is no uniform thing here anymore, so I can't answer this question specifically for you because I don't know what your situation is with your broker. Don't know who you're using. I don't know their rules. Even if you tell me who you're using, I can't tell you what the scenario is. So attempt to enter an order and just set one up and just see if as you enter it, whether the brokerage firm gives you alerts or indications of what kind of margin requirement you have or limitations you have. But you might be able to write a contract against this contract. Yeah. Everyone's talking about Sofi lockup. What does that mean, lockup? All companies that go public, whether they go public with an IPO or whether they go public through the SPAC thing or whether one company takes over another company, there are lockup agreements that are negotiated before companies go public. And in the case of the SEC, there are lockup agreements or there are lockup provisions that are mandatory for brand new listings, especially on IPOs. But even on SPACs, where there are certain amount of days or weeks or months or years that certain levels of investors must adhere to for lockup, where they can't sell their stock, they can't pledge their stock as an asset against a loan, this kind of stuff. So they own stock, yes, but it is utterly unusable for collateral or anything like that. You can't borrow at the short and all this kind of stuff. So lockup periods vary depending on the company and who you are. So if you are if you're a dominant shareholder and you own more than 10% of the stock, or you're part of a group that owns more than 10% of the company, maybe there's 5 of you that are all directors and combined you own 25% of the company, all of you might be in a lockup agreement that is either already preset by the SEC or you've entered into a lockup agreement with your underwriter, with the Wall Street bankers that are helping you go public. The Wall Street bankers are going to say, look, we can't have you guys immediately sell your position into the street the minute we take you public, because it'll be impossible for us to bring new investors in to buy stock at, say, $30 a share, when you guys who got in and created this company 5-10 years ago, and you got this stock at a penny a share when you had nothing, you built this company up, you now want to sell your stock right away. Everyone knows you want to do it. No one's going to buy your $30 stock. I mean, why would anyone buy your stock for 30 if we know you're just going to get out? Who's going to run this thing? So there's lockup agreements. And in some cases, these can last 5 years. They can go quite a long time. There might be a 20% release every year for 5 years. And this shows investors, like the poker hand is opened up, and the investors go, okay, so the chairman of the board and the CEO and the other directors over here, these guys aren't selling any of their stock because, one, they got a lockup agreement. But two, the reality is all of these people, ladies and gentlemen, will likely have stock options from the treasury of the company to get more stock based on the performance of the company. So the better the company performs, the more shares they can buy from the treasury at a set price. And of course, if they do well, their stock will do well. And as the stock does well, their options are in the money and get more valuable. You can guarantee that they're going to exercise their options. So lockup agreements are a way for the company and management of the company to show the market, hey, we're not Johnny-come-latelys. We're not going to flip and take off. We're going to run this company much higher. We've got stock options to get more stock. We don't have enough stock. We want more stock. We get a nice salary to be here. We have bonuses to be here. We're getting stock option bonuses. We're fans of the upward movement of the stock. But there are employees who are, the ground level employees who for years and years and years have been taking 5% of their paycheck into the company as a private company, and the company matches it with another 5% contribution and buying shares for them as a private entity. And so there are some people out there who make $40,000 a year, $60,000 a year, $100,000 a year, but they're not like upper echelon directors who've earned 3, 4, 5, 10,000 shares over all the years they've been there. And they have lockup periods maybe for the first 90 days. And then every 90 days after that, they can sell up to 20% of their stock if they want to. They can pledge it against a mortgage or a car loan or a home improvement loan without selling the stock. They can just pledge it as collateral with their bank. I mean, it now frees them up financially with something. And many of them will likely have these shares inside 401ks or inside Roths or what have you. And they might sell some of those shares because everything they have, every asset they have, every dollar they have in assets, other than maybe a house if they even have one, or maybe they're renting an apartment, their entire net worth is made up of just this stock. They don't have anything else. Well, their personal financial advisors might say, well, look, you got about $100,000 worth of stock in Sofi here, and you have nothing else. You might want to lessen your load a little bit and diversify into some IBM stock, maybe get some Apple, maybe buy an ETF, maybe buy a hedge fund, maybe buy an ETF, some kind of stuff. Diversify your portfolio a little bit, and so that you don't have everything into just Sofi. How about selling covered calls? If you're up 25%, should you buy it back to secure your shares and profit, or still the 50% profit as well? Thank you, sir. Finville, this depends again on the contract and the timing and everything else. If you're writing calls against GameStop, and you're looking to bring in income, I wouldn't use a percentage rule. No, I would use more of a rule where you're watching the variation of the stock. You're watching its movement. So if you write a call contract on GameStop at say $6 a contract, and the shares take a bit of a dip, and the days go by, and the deterioration is happening on the contract anyway because of time, and then you have a down dip on the stock, and now you can score $2, $3, $3.50 on a contract. Or you wrote a contract at $5 and it's trading at $1 with 4 days to go, buy it back. Forget the last dollar for the next 5 days to go. Just get out of that trade now, because you're better off now being flat, taking your money off the table, and sitting back and waiting for your next opportunity to write a new contract that might be for the next Friday or a different strike price to bring in premium again that will shrink on you. You're constantly looking for options that are deteriorating rapidly with time. If they've already deteriorated down to $1, you're out of this. Forget about it. Those were used to be $5 contracts, and now they're $1.50. Move on. If you can rewrite new contracts that are week out or week out again for $4, $6, $8, $9 that are going to go down to that $2, $3 mark on depreciation of time, on deterioration, that's where you want to be. You want to be in the sweet spot all the time, so that if every day your options are deteriorating 50 cents, 80 cents, $1 a day in shrinkage from time shrinkage, that's where you want to be. So I'm asking for a friend, what is a market cap? It's the value of a public company. You take the share price, multiply by how many shares exist. That's the market capitalization of a public company. So if they have 1 million shares outstanding and they traded $1 a share, that's $1 million market cap. If they have 10 million shares outstanding and they traded $1 a share, it's a $10 million market cap. It's all simple. Market price of the stock multiplied by how many shares exist. That's your market cap. Apple, to give you an idea of what a market cap can go up to, Apple at 148.57 is a market cap of $2,456,000,000. $2.4 trillion market cap for Apple, just to give you an idea. Tesla's market cap, $683 billion. IBM's market cap, $127 billion. Home Depot's market cap, $343 billion. GameStop's market cap, $11.95 billion. Let's round it up to $12 billion market cap for GameStop. AMC's market cap, $19.2 billion. Multiply the number of shares outstanding by the price per share. Thank you, everybody, for that. If you'd like to talk to me about a 1-hour session, you want to get together with me, send me an email through my email address, which is right here. It's the old school hotmail.com email address. Send me an email. Say, Bruce, I'd like to talk to you on a one-on-one session. When can you book me in? I'd like to make a reservation and lock it in right away.